Yeah, what's up? Felipe here. In this particular video, I'm going to be talking about a financial concept that I feel is super important in the financial environment today. I'll start off by saying if finance or learning financial things are not your cup of tea or in your ballpark or something you're not interested in, definitely don't watch this video. But before starting, I'll kind of share a quote that I've come across a very interesting book called The Lessons of History. It's short, it's a very short book, but it has some really interesting stuff in there. And in that book, I came across this quote, which I really like. It goes like this: History reports that the man who can manage men manage the man who can manage only things, and the man who can manage money manage all. So the bankers watching the trends in agricultural industry and trade, inviting and directing the flow of capital, putting our money doubtly and trebly to work, controlling loans and interests and enterprise, running great risks to make great gains, rise to the top of the economic pyramid. And then again, I found that in the book, The Lessons of History, super interesting book, some good stuff in there. But essentially, what I'm going to be talking about is something that is a little bit on the advanced side finance, and it's called convexity. I definitely am not an expert in this stuff. It's something that I've come across in the past, and I find it interesting today as it relates to many different areas of the market and the economy. Specifically, I came across it recently in researching the oil markets, which I like to understand because it's what makes the wheels go around in the world pretty much. And it's an area that I like to invest in and have a good understanding in. So, before I even go into the topic, which is convexity, I'm going to share with you guys what does this relate to? What the hell is this thing? So essentially, convexity relates to the bond markets. If you're not familiar with the bond markets, it's the most important market in the world. It provides the financing for everything, the creation of money, the creation of credit. It's the most important market in the world. Without the bond markets, there are no other markets. There are no currency markets. There are no stock markets. There are no markets. So if you're not familiar with the bonds, and it can be confusing initially when I first heard about a bond, I'm like, what the hell is a bond? It's essentially an IOU. An investor who is at the same time a lender and a creditor lends a specific amount of money to a borrower. That borrower uses that money however they see fit. That borrower pays interest to the investor, the lender, to lend the money, right? And then at the end of a specified period, the borrower has to return the initial principal to the investor. An example, let's say, is the investor loans, to keep it simple, $100 to the borrower, right? So the borrower now receives this $100. They can use whatever, do whatever they want with it, right? Uh, at the end of the day, they're borrowing the money, right? Let's say that the stated rate is, I don't know, 10% interest on an annual basis, right? So what is 10% of $100? That's $10, right? So let's say that this bond it matures in 1 year. So in 1 year, this borrower has to return the principal plus the interest to the lender, right? So at the end of that year, the borrower has to return the $100 plus the 10% interest, which is $10, right? So a total of $110, right, to the investor. So that's just a quick example how bonds work, and that's kind of like my fifth grade explanation of it. So now to the topic in hand and what I actually want to be talking about, which is convexity. And I'm going to kind of go bit by bit to hopefully make this as understandable as possible. So the reason I find this like super interesting now more than ever, or I mean, I think it's always been important, is because of the financial economic environment, like I was mentioning, like what the Treasury is doing, and essentially buying back treasuries. So it's attempting to, in a way, stimulate the economy. Meanwhile, the U.S. Treasury Department has also been pretty much helping the Japanese yen situation through those efforts. So that's where this comes into play essentially. So convexity, it has two forms, it has positive and negative, like most things. To simplify, convexity is good. The more convex a bond is, which is what I was just talking about, the more money you would make on it when interest rate changes. This explains the weird. This explanation works for the bizarre term negative complexity too. In if convexity is good, what do you think about negative convexity? If if you answered that negative convexity is bad, you are correct. So to kind of like make this make a little more sense, I'm just gonna draw what this kind of means. So typically bonds are like inverse to rates. So let's say this is a bond, right? When rates go up, bond values go down. So if interest rates are going up, bond values go down. And then the same is true vice versa. When interest rates go down, bond values go up. So that's essentially uh, what positive convexity and negative convexity is defining. Pretty much this. And then I'll kind of leave it at that for now. But that's pretty much in essence what that means. So back over here, I'm just going to go into like basically bullet points to hopefully make this make as much sense as possible, not only to y'all, but to myself as well. Convexity is a measure of how the price of a bond changes in response to interest rates. It's a more precise measure than duration, which only considers the first derivative of the bond's price with respect to interest rates. Duration is, again, in the example I just did, maturity rate. I kind of drew on the little thing that bond expired in a year. So that's what duration is. So why is convexity importance? And the reason why convexity is important is nonlinear relationship. Bond prices and interest rates have a nonlinear relationship. This means that the change in bond price for a given change in interest rate is not constant. Convexity captures this non-linearity. Risk management. Investors use convexity to assess the potential risk and returns of a bond portfolio. A bond with higher convexity will experience a larger price increase when interest rates fall than a bond with lower convexity. This can be beneficial during periods of falling interest rates. So that creates a potential money-making opportunity in falling interest rate environments, as well as rising interest rate environments for people willing to take that risk and that opportunity. So to give an example, from my understanding, bonds with the highest convexity will experience larger price increases when interest rates fall. A beautiful example of a bond with a very high convexity would be a zero coupon bonds. They're typically the ones with the highest convexity. Another example would be a longer term duration bond, like a 30-year US government bond, would have more interest convexity than a shorter term bonds. So now to kind of go a little forward on this, I'm definitely not going to go into how this stuff is calculated because that's like a bunch of math. The exact formula for calculating convexity involved higher order derivatives of the bond's price fluctuation. However, simplified understanding can be gained by considering the following. Convexity is positive in most bonds. This means that as interest rates decline, the bond price increases at an increasing rate. So kind of like the little thing I drew, the little seesaw thing. Higher convexity means greater price sensitivity. A bond with higher convexity will experience a larger price change for a given change in interest rates. This also relates to essentially other parts of the market, which is pretty interesting. Convexity and options, futures and forwards. Options, if you haven't heard of them, they're essentially a way to speculate or hedge. Futures and forwards are the same. Futures are interesting because it's essentially the commodities markets, among other things, where large income corporations like buy in bulk their commodities, and speculators also participate in those markets. Convexity is particularly important in the context of derivatives, which are all these things: options, futures, and forwards, especially options. Option pricing, the Black-Scholes model commonly used for pricing options, incorporates convexity as a factor. This is because the option's payoff is non-linearly related to the underlying asset's price, which is influenced by interest rates. Hedging, so essentially, have an understanding of this, you can hedge or essentially have insurance against this particular thing. So convexity can be used to hedge interest rate risk in bond portfolios by combining bonds with different convexities. Investors can create a portfolio that is less sensitive to interest rates, to changes in interest rates. Now to just kind of go a little over, because what we've been talking about is positive convexity, kind of go over a little bit of negative convexity, which is the opposite. Negative convexity is most likely to occur in bonds with embedded options, such as these are essentially bonds have specific pros and cons depending on the agreements of the bond, right? Such as callable bonds and puttable bonds. Callable bond, these bonds can be redeemed early by the issuer at a predetermined price. When interest rates fall, the issuer becomes more likely to call the bond, reducing its potential appreciation. That typically is not good for the investor. It's better for the borrower or the issuer of the bond. Puttable bonds, these bonds can be sold back to the issuer at a predetermined price. When interest rates rise, the investor becomes more likely to put that bond back to the issuer, limiting the potential price decline. Because as I mentioned, through the little thing I was drawing, the little seesaw, when interest rates rise, bond values go down. And same on the other end, when interest rates decline, bond values go up. So puttable bonds are typically beneficial for the investor. Why is negative convexity important? Negative convexity can be a significant risk factor for investors. If interest rates decline, a bond with a negative convexity may not experience the same price appreciation as a bond with positive convexity. This can lead to underperformance relative to other bonds in the portfolio. So an example that comes to mind of negative convexity in contrast to positive convexity is essentially shorter dated bonds, meaning they mature at a shorter date than a longer term bond. For example, 1 year US Treasury versus a 30-year US Treasury. There's pretty large gap in time there. So the one that is a shorter dated Treasury would have more negative convexity than the one that is a 30-year, which would have more of a positive convexity. And lastly, I just kind of want to go into this that I found interesting, and I'm myself trying to get a better understanding of it, is the forward yield curves are a basic but crucial concept in selling derivatives. The most simple yield curve is the curve that describes government bond yields for various maturities. Usually the curve slopes upward because as the maturity of the government bond increases, its yield also increases. You can think about this curve in terms of a bank certificate of deposit. You're likely to get a higher rate with a 5-year CD than with a 1-year CD. A yield curve is simply a graph of interest rates of different maturities. To kind of go a little further into this, and then kind of end it at that. But the most important yield curve to derivative salesmen is one you won't find in the financial pages, the forward yield curve or forward curve. Actually, there are many forward curves, but all are based on the same idea. A forward curve is like a time machine. It tells you what the market is predicting the current yield curve will look like at some point forward in time. Embedded in the current yield curve are forward curves for various forward times. For example, the 1-year forward curve tells you what the current yield is predicting. The same curve will look like in 1 year. The 2-year forward curve tells you what the current yield is predicting. The same curve will look like in 2 years. Instead of the yield curve's prediction arise almost like magic, but not quite, out of arbitrage, so-called riskless trades to capture price differences between bonds in an active liquid bond market. That one still goes over my head, but I'm sure the more I read it, the more of an understanding I'll have to it. Just remember this. If today's yield curve is flat, the forward yield curve is flat. If today's yield curve is steep, the forward curve is higher and steeper. In a way, the forward curve simply stretches or magnifies the shape of the current yield curve. And if you don't believe what the forward curve is predicting, then derivatives allow you to bet against the forward curve. So essentially, the forward curve seems to be the market's expectation of what the future yield is going to be. And here it just says essentially, if you don't believe what the market is saying, you can bet against the market. And hopefully you're right. If you're right, you make money. If you're wrong, you lose a bunch of money. This stuff I kind of picked up from a book called Fiasco, which is really good. It kind of goes into all the sketchy stuff that happens in the derivative markets and how corporations use them in many sketchy ways to essentially hedge or make money. But me personally, I found this interesting to understand now, specifically because of what is going on with the US Treasury and the topic of interest rates that is like pretty much important for anything financial when it comes to loans, the housing market, everything. It just has a major influence. So hopefully that made some sense. And if it didn't, let me know if you got any questions, and I'll see you guys on the next one. Have a good one.